First of all, I have to put a disclaimer on the screen. Please consult your financial advisor, CPA, and attorney before investing, since we are neither. This event is recorded, and you may request a copy of the recording for a later review. I'm Charles Weiner. I live in Fort Myers, Florida. I've been married for 35 years to Arena. I have two beautiful little kids, 32 and 34. My first job was when I was 17. I was installing car alarm systems, and I'm an electrical engineer. I was involved with large telecom companies, one of which I founded from the ground up and was acquired later on by a publicly traded company, Nasdaq, making me their president and CEO. I always invested in single-family homes and duplexes and RV lots, and I wanted to grow my holdings. And I just didn't want to be the landlord. So that I started researching multifamily properties. And initially I invested as a passive investor, learning how professionals live. I was seeking help. So from mentors and coaches, I turned to Peter Harris, to Brad Samrock, to Vlad Bracer, and Rod Cliff, which later I became a co-GP with. I'm a private pilot, therefore I like checklists and I like systems and procedures in place. The multifamily syndication has a lot of moving parts, so you have to be very structured to make it work, and you have to have very successful partners to make the whole syndication go forward and be successful. Each of the partners takes, different main roles, but we all do different things, and we all share responsibilities. I rely on my extensive experience and I contribute to asset management, investor relations, and capital raising. Donato here, he's more about underwriting, among other roles. I'll let him introduce himself in a minute. I'm doing this full time. This is my day job every day. I had ambitious goals initially. I wanted to do 1,000 doors in 1,000 days, but be careful what you wish. This is going way faster and a lot of growing pains. So, I may get that goal way sooner. But the motivation is not about the doors. It's about helping others to discover multifamily, to see how good of an investment it is, and about leaving a legacy and helping others. I support several charities. Those of you who follow me on social media know that I support St. Jude Hospital for Children, and the Shriners Hospital. And, we're constantly fundraising for them. But enough myself. Donato, introduce yourself for a minute.
Absolutely. So my name is Donato Callahan, and I get the pleasure of working with Charles in the multifamily space. My background is actually in the STEM fields and sciences. I went to school for biology before going to work for the Department of Defense as a geospatial analyst, at which point I elected to take my skill sets to the entrepreneurial side, starting my own software company and getting into multifamily real estate as an acquisitions specialist, meaning I am the person on the front lines who's looking for deals, looking for opportunities, and putting the numbers together on how we can improve tenant lives while also being able to generate nice returns for our investors who partner with us and turning around these communities.
Great. Let's continue here. A little bit of this thing did double click, sorry. The overview, what we're going to do today, it's look at cash flow and tax savings. Of course, we are not tax experts. We know a lot about it, but definitely we're not CPAs or tax attorneys. So I repeat, consult with a professional before investing. But we look at some of these elements, so get you started and interested. This is for both experienced investors. We're all about education and helping new investors. It's also for curious newcomers. You'll get, valuable information, and this is, the basics. So if you're interested later on, you can just turn to us and, put the link on the chat so you can follow us, and I'll turn to, for a one-to-one consultation. I'm going to talk a little bit why I invest in multifamily real estate. And part of this is, what we discuss here, cash flow, tax benefits, appreciation. Cash flow comes from the rents that we collect from the property, and that is distributed between the partners. I'm going to discuss a little bit later how the partnership is comprised, but that's directly the cash flow that we get. The asset appreciation comes with time, and we're investing in fixing it to make it nicer so we can raise the rents, and that appreciates the value of the business. There's a lot more demand lately for rentals. I'm going to also explain why, but it becomes obvious that owning a home today is very difficult. So a lot of the younger people resort to renting. There's a lot of tax benefits. It's not how much money you make, it's how much money you keep at the end. And economies of scale, I mentioned before, I invested early in single family homes, but here you're buying a large group of apartments at a time. And that really helps you in a case like on a single family, you lose a tenant, you lost 100% of your tenants for that property. In a multifamily, if you lose 10 tenants, you still have hundreds more. So that's usually very interesting. If you wanted to add something, Donato, feel free to jump in. We'll do a little ping pong here.
Absolutely. And I think that one of the coolest parts about multifamily real estate compared to other investment types, where we're still able to generate a profit, we're still able to generate value in a couple different ways through the appreciation, also the cash flow, and very industry specific tax benefits to be able to offset your guys' incomes from your other passive investments is the people component. When it comes to these types of projects, Charles can speak to the fact, he's visiting our latest project just next week. When you walk onto a multifamily investment, we're improving tenant lives. We're actually taking people's living situation, and through these investor capital, we're able to improve their living experience. We get to make them happier when it comes to inviting people to their homes. They get to envision their kids, their pets being there for years on end. And we get to be a part of their lives and the families that we're actually housing. So it's one of the few investment types that comes with both the financial return on your investment, while also being able to say that you had a positive impact on both the community and individual people's lives through the dollars that we're committing these projects. So I think that's a huge part of multifamily real estate that can't be ignored when it comes to all these other benefits as well.
I'm comparing here, the inflation versus savings. Some people says, well, like the savings account are paying, more now, so I can just put my money in a savings account, it's safe. But if you figure, there is, about 3.1% inflation, that's the rate. I don't know if you went to a supermarket lately, but there's definitely way more than that. And I printed this for a previous presentation, but it's still about right. The banks are paying somewhere between 4 to 5%. And the one that pays the most, if you look at this list here, is this Genius Bank with a J. I don't know if you will invest in a bank that's called Genius, but there's not a lot of money on the savings account. So you have to find investments that actually not only give you cash flow, but long-term appreciation as well. And here, what I put up before, renting versus owning, this is, more families resort to renting because of, the inflations and the cost of a single family home makes it almost impossible to buy a new home. And this gap here that you can see, it gets bigger and bigger with time. It's, the cost of the single family homes keeps growing, and the rents also grew, but not at the same pace. So that gap keeps getting bigger and bigger. Here, I'll put, real estate versus stocks. As some people ask me, oh, so, I have the money on stocks. And that's really been a roller coaster, and even though the market's doing well in the last, year or so, but you never know. It's been very moody. I don't know if you follow GameStop or some of the stocks that may change 100% from day to night. So it's been crazy. So in real estate, it's a tangible asset. The sponsor controls the property. There's more stability. Definitely, we do a lot of due diligence before we invest in any of these properties, and the tax advantages that we'll talk here later. Some of tax benefits, and again, this is just the tip of the iceberg, and we want to get interested, but we don't have all the answers. We have really smart attorneys that we work with that definitely know way more than us. But real estate syndication income is taxed as passive income. You invest as a passive investor, so that gives you a lot of benefits. The IRS considers the passive investment as something can offset against your W-2 or as an LLC if you have a company that you're working with. There's a powerful tax advantage. Again, the depreciations. I'll show some of the slides on how we depreciate these assets, and that benefits from the value of the property and how we can depreciate instead of waiting 30 years to depreciate the whole property, how we can accelerate that. The 1031 exchange really is at the end. If you're not, if you don't want to pay any of the capital gains, we can defer paying the capital gains by, investing on the next property and moving, actually deferring your tax liability to the next property. And it's all about maximizing tax savings. This cash out refinance. There is, mortgage interest that you can deduct. There's a lot of other activities. And, again, Donato, if you want to add something that I missed here, you're welcome to jump in. Although they can't see you there, but they can hear you.
Yeah, the tax benefits of multifamily syndication are definitely one of the standout components. Something that's important, I know Charles touched on it, but very important component of the tax savings is that as a passive investor in the multifamily opportunities, a lot of times people think that you can use this tax savings to offset your active income, and that's not the case. So when you're going to invest as an LP or a limited partner into a deal like this with a group like ours, it is important that any tax savings that you're looking to transfer to your own income, they can only be used to offset your other passive income. So things through capital gains or other passive income that you're already taking in. So if you're a high net worth individual who's earning high salary at a W-2 job, this type of tax benefit is not going to directly impact you. If you are someone who has other passive investments already coming in, either through 401ks or through stock market investing or through other real estate investments, any other types of passive investments, this can virtually reduce your income on the passive side to almost zero, depending on how you actually, how much is invested into an opportunity like this. But that is one big component that I know folks will invest in multifamilies and not fully understand is the tax benefits apply to other passive income streams that you have existing, and that it can be carried forward. It can be carried forward. So as you do multiple deals and continue to grow your portfolio and you're investing, it really snowballs into a continual tax saving event.
Yes, and you basically get a K1 from the partnership. That's how you file your taxes and take advantage of. I talk here about a little bit of the bonus depreciation, and this the government 2 or 3 years ago, 21 I think was they had this 100% bonus depreciation, and it was lowering the rate 20% every year. So 2024 we're sitting at 60% bonus depreciation, and that means basically that we can depreciate 60% of that investment on the first year. Again, there's a lot of nuances on this thing, and it's going to go down 20% for 25 and 20% for 26, and it's going to end January 1st on 27. That's expired. But the House passed a vote to extend the 100% bonus depreciation through 2026, but it got stuck on the Senate, and we haven't heard back from that. And it's an election year, so very doubtful that it will move anywhere forward this year. But it was a good try. But again, the bonus depreciation has a good impact. Also, we used, like cost segregation. We hire a company that does cost segregation, and we can break down the different parts of the building, except the land, in 5, 7, and 15-year depreciation schedules, and that helps you to accelerate the property value as well. Of course, if we sell the property very early, you have to, replenish. If you claim these deductions, you may need to pay back some of that. But if we wait for the 5 years, a lot of that is being used as well. The synergy of cash flow and tax savings. Again, my main point here is, you get a monthly payment from the income on the property once the property starts producing high occupancy, and it does distributions, so you get a monthly payment. That's your cash flow and tax savings on the filings, the K1 every year. Of course, here we talk about risk management as well and the resilience of the multifamily markets. Again, Donato, a lot about this part more than me, so if you want to just throw a couple of words there, that'll help.
Absolutely. So when it comes to the acquisition process, right, it's clarifying the acquisition process, right, Charles, on this component. Maximizing returns and the acquisition process to find the best value creation comes down to a couple things. And really, multifamily is a really simple business. It all comes down to how can we get property that is the most likely to keep people wanting to live there for the longest period of time, and being able to pick a property that is in a situation where it's going to continue to have high demand because of the location around it. If we can do those two things, the rest of the job gets really easy. And so one way that we do that is by looking at market research and making sure that we're investing in areas that have growing populations with diverse employers, and making sure the incomes are continuing to go up at a rate that people will be able to afford the rents we need to be able to charge comfortably. With that, choosing properties that have specific types of actual bedroom counts. For example, a 2-bedroom apartment can apply and house way more people than a 1-bedroom can. A 2-bedroom can appeal to someone who's working from home remote, or a young couple, or a couple with their first kid, or someone that wants to have a guest room for friends and family. So by looking for apartments that have desirable types of units, we're able to maximize our cash flow by appealing to folks who can live in this apartment through a wider degree of their life, thereby reducing our actual vacancy costs. And then when it comes to maximizing our returns, all we have to do is increase our revenue or our net operating income while reducing our expenses. And one of the ways that we do that is being able to do unit upgrades, being able to renovate units, improve tenant lives through really supreme exterior amenities such as pools and areas to lounge and barbecue areas that really bring the community together, all of which create a dynamic in the community of lower risk, fewer people moving out, will stay with us for longer periods of time, and we're able to charge higher and higher rents as we continue to improve the property, that in turn prompts them to stay for longer and longer. So it really becomes this nice cycle of how this lower risk assets in the right location with the right properties all come together to improve lives and make money over time by pairing up all those things together. And then as we do so, being able to take those tax savings through what Charles mentioned, through these studies that we do, makes it a really cool and effective, profitable investment.
That is absolutely great. I want to talk a little bit about the structure of multifamily syndication, because some people don't understand how the two components work. So again, being a pilot, I use a lot of airplanes here as a sample. But the structure of multifamily syndication basically has two components: the sponsor team and the investors. The sponsor team is also investing as a passive investor. We have two, well, on the same partnership, on a limited liability corporation, and we have two classes of shares, but we're all together. The sponsor team is in the cockpit, and we need to find the asset. The plane really is the multifamily property in this case. The sponsor team, are the skilled pilots navigating the complex real estate machine, avoiding turbulence and looking for the best airport to land. The passive investors here in the back, are the business class passengers who pay for the travel ticket. They trusted the pilots to take them to the destination while they enjoy dinner and movie, and while being informed by the crew of the cruising trajectory. So there's two parts of this. So we find the asset, we do the due diligence to make sure that the asset is compliant to the way we like to invest. We secure the financing, we raise the capital, we do the asset management, the value-added strategy, the investor relations, and we plan the exit strategy. The passive investor, in this case, they have to do the due diligence to find the right sponsor team. The partner with the sponsor teams is very important. They get the ongoing communication from the sponsor team. They sit back and enjoy the returns, the asset appreciation, and the exit profit is at the end. And then, obviously, if everything went good, they get invested in the next deal as well. The most common percentage between the two parts is, there's all kinds, but the most common is 70-30. So the passive investors will get 70% of the property, and the sponsor team gets about 30% of the property. And I want to just introduce the sponsor team on one of the particular deals, just so you know the quality of the people that we work with. In this case, again, Donato is part of CREEF Capital, and I'm with the Winers Investment Group. So CREEF Capital, it's a large operator directed by Rodcliffe. It's an entrepreneur with, it's a real estate investor with, multiple businesses. He's an owner, an author, and, he's passionate about business. And I think it's a country top real estate trainers. Donato, add a little bit about that. your team?
Yeah. And one thing I'll mention too about the previous slide when it comes to investing is, we really consider, especially, the Cree Capital Group and Wainers Investment Group, you're really not just investors. You're truly limited partners in the sense that when it comes to investing with us, you partner in the actual asset and the design, being able to work with us on how we're actually moving things forward, and you get to be a part of the journey. So many of our partners, receive weekly updates on how the property is performing, what we're doing with it, seeing the renovation projects as they go on. And so it really becomes an involvement of being able to see the actual return on what the work is and what the investment is in real time. So I think it's really key that folks who invest with groups like ours recognize that they're getting the opportunity to partner and be involved at the degree that they like to be when it comes to seeing the actual development and improvements going on, as opposed to, a generalized investor who may not get to see behind the curtain as often, and a bit more in the dark. So we really pride ourselves in being able to bring on partners to our opportunities. Now, when it comes to Cree, we've been very blessed over the years to be able to accrue a portfolio of over nearly 5,000 units and nearly $500 million in assets under management with a lot of experience. And the fact that our chief investment officer, Rod Khalif, has the #1 commercial real estate podcast in our industry with, I think, nearly 20 million downloads over time. So very, very wide reach. So we're able to help a lot of folks, whether that's from their very first partnership as a limited partner, all the way to folks who've been partnering and investing for decades, all collectively. So we're really excited to be able to find great folks like Charles to come together with and invest with and create opportunities for folks to protect their assets, create better lives for tenants, and make a profitable return all at the same time. So my role being a regional manager in that, finding opportunities like the one Charles and I have done together, and being able to go find the very next community we get to improve upon is what I get to do on a day-to-day basis. And it's what I do all the time. It's my day-to-day, and I do it from sun up till sundown, working with our limited partners as well. So it's an absolute pleasure.
Great. I want to just talk a little bit about the magic, how we create value. Because, the properties usually, yes, we find great deals, but that in itself doesn't have value. That we create value by actually, adding value to the property, being that as, capital investments or performing, adding additional income streams. And something that the value, the economies of scale, I would say, on a multifamily is that you have a lot of units. So on $100 rent increase, which is a lot actually, you talk about, let's say, you increase $100 on a 200 unit complex. That that in itself is $240,000 a year in net operating income. That, I mean, there's no exact number, but that will raise the value of the property, over $2 million. So definitely, we're always looking for ways to improve value on the property. Sometimes by adding, little things like charging for parking or washer and dryer, or like a smart home package. There's different ways to add value, and all those, although they're all little numbers, but multiplied by the amount of units, they create a lot of additional net operating income that doesn't come straight from rent as well.
Yeah, and so there's a great example on the asset that we just did. In today's economy, right? Everyone needs internet. Whether you're working from home or not, everyone needs to have internet access. And so on this property, we were able to find out that most of the tenants were paying, say, I think $70 a month in internet. And we, as a part of our value add, are able to come in and switch providers for them and give all the tenants, I believe, a $7 to $10 per month reduction in the internet they're paying for with another high quality provider. But at the same time, they get a discount on the internet they're paying for, and we now get a portion of the cost that they are paying every single month for the internet. And so they're saving the $10. We're making $30 per unit for every person that has internet on the property. And because we were able to get that internet income for 200 units of property, we're actually increasing the property's value by $1.6 million. So that's what we call a triple win in value. Tenants get to save money on something they were going to buy regardless. We get to make money by providing a high quality service and raise the property's value by over $1.5 million. That's one of those really cool ways that we can create value on these properties, in addition to all the things that Charles had mentioned that we get to be creative on. It's a really, really cool situation where if we can do things like that, it results in seven figure boosts to our valuation.
Yeah, that's incredible. Again, the economies of scale right there. Yeah. Well, revenue-based matrix. This is things that we look before we invest. Actually, when we select the property, we have a lot of parameters that make sense. It's not just that the property is great or the area is great. There's a lot of parameters that will assure success. There's the parameters that I mentioned here, but also, like inflation, Fed rates, things that we look when we underwrite a property. And, these are very important metrics that we use to decide if the property is going to make it long term and if it's going to be profitable or not. And again, we have experts on the team. I think that Donato is one of the underwriters that look at these things. I think there's a lot.
That's me.
That's it.
That's what I do.
A lot to discuss on this, but if you want to add on this, that's great. I mean, I look at the parameters. I can generalize, but you know a lot more about the details of what we look when we research a property.
Yeah, and so really, there's a lot of numbers here and descriptions, but what it really means is how do we get into an area that's growing with more jobs, where incomes are getting higher every year, that there is new construction going on, bringing new businesses and new housing supply, where we know that home prices are also going up. So it's cheaper to rent from us than it is to, say, buy a house. So we can provide that service, while at the same time, the rent that we need to charge and the income that people are making nearby is at a healthy ratio so that we're not pricing people out and we're also not leaving money on the table. And when we can find cities, zip codes, and even streets that meet all that criteria, we're doing a really good job. And that what tells us we have a winning strategy to move forward with an investment opportunity.
We have a short case study. I mean, this is a property that we have in San Antonio. Actually, I'll put some slides. It's not a whole presentation. It's just 3 or 4 slides from a previous presentation. This is a property that we have in San Antonio. We closed in April 23rd. It's a beautiful property. It's Class B building with 200 units in 10 buildings, built in 1982. The property was offered at market price of 28 million, and after intense negotiation, we acquired it for 20 million or 100,000 per unit. And we have the comparison here with the properties around us that they're all 30 to 40% higher comparables. This is a unique lakefront property, one of only 3 apartment rentals on a lake in San Antonio, and has a lot of amenities. This property, we use conservative financing when we acquire it. And, we assume an existing agency loan of 13 or so million at an excellent rate of 4.05, which is a rate that you cannot get directly from a bank right now. We raised a little over $12 million. My allocation, I just have 2 spots left. So if anybody's interested and want to talk about it offline, I'm going to put some links at the end of the presentation. And this project, we're going to invest about 3.7 million on CapEx, or capital expenditures. We're already working on it. I think we have like 10 different contractors working on the property right now. I'm going to be there in the next 3 or 4 days. I'm going to stay there for 10 days, checking on the contractors, making sure everybody's working. We have someone that's boots on the ground, that's taking a vacation. So all the other partners chip in, and we work on the property. I'm going to have one of my investors as well visiting the property when I'm there, because they want to see what they invested on. And, people that, their partners, that are welcome to come and take a look at the property. If you want to add something, Donato, on this one, on the financing or underwriting?
Yeah, absolutely. So Charles is right. This opportunity we just closed on a month ago, a month and a half ago now, and it's been fantastic. We've already done, I think, almost over a dozen unit renovations, pools being redone, the exteriors are being redone. The tenants are really happy that they have a management team that's coming in to actually inject some capital into the deal and really spruce the place up. Because this deal, it's right on this amazing man-made lake. And when I visited the property not too long ago, it's the kind of place where kids are taking, kids are learning how to fish for the first time. People are taking walks after work, and it really has a resort type feel of just a community you want to be a part of. So we're really happy that we're able to bring almost $4 million to help renovate this property up to what we think we can do. And when he talked a little bit about that Wi-Fi package, where we're able to add $1.5 million in valuation to the deal just by adding Wi-Fi that's cheaper than what they're already using. That's on this deal and this opportunity. So we're seeing great progress on the renovations right now. And because it's already closed and renovations are already happening, it's a really great opportunity to hop in as an investor in one of Charles's last two spots, because the risk of not closing has already been eliminated and the renovation plan is already being implemented. And so those of you who are interested in being a part of a syndication at a lower risk than getting into something that's just under contract, and you want to be a part of something that includes having a resort type field with a team that likes to really prioritize the benefits of improving tenant lives while also providing value, I think this is a great opportunity to come into and be able to get those returns that you need, especially for someone who has some tax savings they want to be able to implement and some valuation they want to be able to pull in the next couple of years. So we're really happy about this one. And like Charles said, we're going to be there in the next couple of years. And so with a deal like this, typically the investment returns that our investors are going to be getting is a 7% preferred return, basically meaning that all of you as investors that come into a deal like this, and any deal that comes into a syndication, means that you get paid first. So the first 7% of the profits are going right back to you before anybody else on the general partner team takes a dime. Deals like this, we're holding for 5 years. It means that we're going to get in there, we're going to make our renovations, we're going to add value, improve the tenant lives, and then be able to sell this property in about 5 years to return your capital and a nice return on top of that capital. And we're projecting a total IRR or internal rate of return of about 15% conservatively. We very much prioritize, and I know Charles does this as well, right? We like to under promise and over deliver. And so we're coming in, we're feeling we can do pretty well in the 15%, but with the outstanding progress we're seeing on things like our Wi-Fi package, which was admittedly even better than our best case scenario when it came to revenue for that, and the growth we're seeing already on the process of the unit renovations, there's a very legitimate path towards 17, 18, even 19% on our IRRs as we continue to grow. But of course, we come in and we expect to be able to do this deal, and we underwrite to being able to do 15%, even though we think that we can do better, and we're already seeing ourselves outperform our business plan.
Right, and this is not a complete presentation and no website, but we wanted to, introduce it as a case study. And this property is about a mile and a half away from another property the sponsor has that creates a lot of additional value, because we can share resources between the two buildings, and that savings always help the net operating income. So that is great. I think this pretty much concludes the presentation. I really thank you for participating. There's a QR code you can just scan. I'm going to post here the links. I mean, if the QR code doesn't work for any reason, there's links to get in touch with us. And for any type of questions, anything that you may have. If you have any questions right now, just put on the chat, and I'll open your mic. Spend a couple of minutes. But the idea is that it's an introduction for the new people. If there is any accredited investors, also it's just an introduction so we can initiate the dialogue. But again, thank you for participating, and thank you for your time. It's been 40 minutes or so it's pretty good. If there's no other questions, just either scan the QR code or click on one of the links. Thank you all, and thank you, Donato, for your time. I know it's a little bit early on your side, but it's in the afternoon. So let me see if I stop the share. Can they see us? That's it then. Thank you very much. I really appreciate it.